Good morning, everyone. Today is October 24, 2023. My name is Josip Causic, and welcome to Trading in Review. If you can take a moment and type in your name, I have provided you the code here for the Speak Up app. In that case, you can interact with me while we are live. So after reading the disclaimer and everything, we can then proceed and uh, make sure that you launch this room by using this key. And key number for today's session is 04750. So one more time, hi to all. I'm going to type in here to the chat, and if you can interact with me, that would be wonderful. So today we have a number of things that we're going to do, and one of the things that I want to talk to you first about is market can go bearish, neutral, or bullish. So as you can see over here, I'm bringing you the agenda, and I'm going to go over the big picture, and the question becomes which way is market going to go. So thank you for interacting with me here. Good morning to all of you. And I'm going to start today by going over the Dow Jones Industrial Average first. And what I'm going to do is I'm going to enlarge the chart of the Dow Jones, and I'm going to point out to you this low, which was basically of the March of COVID, and then this higher low that took place in 2020. And we are right now coming back to that, and this is definitely a very clear trend line. Another thing that I'm going to point out here, just to answer the question which way, is February of the last year when the war in Ukraine started, and how coincidentally this trend line that we have here with the blue line and the low of the Ukraine conflict is coming up to the same level, and that could act not like a resistance but more like a support. So having said that, I'm going to now move on to the next one, and the next one is quite different because we're looking at the NASDAQ, and don't forget on the NASDAQ we have Google earnings, and we also have earnings for the Microsoft tonight after the bell. So similar situation I have drawn here for you. March low right here, as well as 2022 multiple lows that have taken place on Nasdaq. And what I'm gonna point out to you over here is what has happened to that February of the 2022 low when war started in Ukraine. As you can see, we're significantly higher from that level, right? So if we are significantly higher from this level, then obviously we're even further away from this whole level of the support. So over here we do have three touches. As you can see, this would be the touch number one that I'm typing here. Then you have a number two a little bit further up, and then you have a number three right at this level. So every time when you're looking at the market and drawing the line, there needs to be minimal of the three touches to consider that. And we have obviously three touches here on the Dow Jones. We have the three touches on the QQQ, and we know that in this case, QQQ is the strongest because it's further away from this uptrending support line. Now, I also want to point out to you the Russell 2000, because the Russell 2000 definitely looks quite different from everything else. Now, notice on the Russell 2000, we have a first touch over here, then we have a second touch over here that points out to you. Thank you for interacting with me here. I really appreciate it. So I know that we're all on the same page and that we are looking good. And we have broken below the trend line. And notice the size of the bar. Now I know October is not completely finished yet, but notice the big size of the red bar versus what you have here on a Nasdaq. On a Nasdaq, we barely have a doji. So if you have on a Nasdaq doji, as you can see over here, um, we also have on S&P doji. So then the question really becomes, which way is the market going, right? Well, obviously on these three, Dow Jones, QQQ, that represents the Nasdaq, as well as the S&P, market is still going neutral or sideways. It's undecided, but on the Russell, we have a clear conviction the trend is broken and that the trend is going down, right? So the summary of this whole thing is that when it comes to the bearishness, right, we have a rattled Russell 2000, or you can use the ETF for that, which is IWM, right? All these other ones, SPY, the diamonds, and also the QQQ are neutral. Then the question becomes, which of these charts is bullish? And I will provide you the ticker here in a moment, but it's CBOE, Chicago Board of Option Exchange, is the one that it's looking the strongest. And we have placed the trade on that a little bit earlier. But what I want to do, I want to actually go over this big picture summary one more time, just to kind of move on to this and be sure that we are good. So thank you for interacting with me. I'm glad you're here. So one more time, what I have here is a big picture summary. I have a blue line that represents the uptrend on the Dow Jones, and then I have a yellow line right here that shows beginning of the war in Ukraine, which was in February of the 2022. And I have used that yellow in all of these four charts as a line of demarcation. And you would notice that not only on Russell 2000 we have broken that uptrend, but we are also trading below that level of the yellow line that I have used as a demarcation for the line in the sand, whether we should be bearish or bullish. And obviously, that's the reason why the Russell is on a bearish side of the equation. And if you're going to place any trade on a bearish side, Russell will be the one that is good. So now notice I have taken a snapshot of the CBOE, and the CBOE is definitely looking bullish. So what we can do, we can actually review the trades that I have placed in a Thinkorswim account on the last session here, and you will notice that I have two accounts here. The one account has $100,000, right? And I have used up some of the buying power. In fact, I've used up $2,000 of the buying power, and ever since we placed that trade has been up $510, and that was a long synthetic. So I can opening up over here and point out to you the long synthetic is actually composed of the, let me just click here on the type of the bull put spread, and also buying of the long calls. So as you can see over here, we have purchased for $20 this 155 call, and it has made us, let me just make a color into green here so it will be obvious, $470 on it, right? Where do we get the $470? Well, the cost was $2,000, so $2,470. That's our profit. While the CBOE 155, 135 put has already moved up, and I'm planning to show you how that thing really looks on an option chain over here. When I pull up the option chain, and what you're going to notice on the option chain, I have a volume and I also have open interest. So obviously nobody has traded today the volume, but when I pull up the intrinsic, you would see when we enter into our position, CBO was sitting at 155, and now that 155 sold put is out of the money because we are currently trading at the 162. So if we are going to look at the bigger picture, of what we can do this morning, I'm going to bring up again the options with options, and we're going to prepare ourselves to trade CBOE on a daily. So you would see how this thing looks. So this thing looks strong uptrend. We do have a little bit of the pullback over here, which means we can do something to our existing position on S&P. Oh, no, not on S&P, on a CBOE. So notice we have a call and we are currently a little bit pulling back. So can we sell something up front? Yes, we could. And what is the one thing that we can sell? Well, we can obviously sell the front cycle. Now notice they have introduced the weekly options on it. So we have a weekly option that we can trade, and we have a couple of choices, 162.50 and 165. The reason why I'm saying we don't have any choice for selling the this one, which is 167.50, is for simple reason that under the bid there's a zero premium on it. So only two choices that we have is either the 165 or 162.50. So having said that, let's look at the chart over here and see where would the 65 be. 65 would be exactly here at the high, right? And obviously 62.50, pretty much we are currently at that level. So we're gonna sell against this thing, one of the 65 front month calls. I will try to get that filled for the mid price, although over here it says it's only 25 cents. I'm going to ask for 35 cents and see if I'm going to get filled. So one more time, repetition of what I'm doing. I'm selling the one contract against my one long contract that I have that is expiring all the way out. And I'm trying to get it at the limit price of the $35. So I'm sending it in, and I got filled for 35. So now when I go over here under my positions, you will notice that I have just added this contract right here of the 65 to my one long call of the 55. So having said that, I just want you to be aware of it. We can repeat the same thing one more time from the beginning as if we are building this option. So I'm going to go over here under the option chain, and I'm going to pull up the option chain for CBOE. And the way how we're going to do this is simply we're going to pick the furthest out possible option, which in our case is going to be the January of the 2025. And we're going to build this in such a way that we're going to start with the current price. So obviously we're currently trading at the 162. So when I'm building this, I want to pick the both of this at being at the 160 level. So what we're doing with the long synthetic, we are actually buying a call and simultaneously financing that call with the selling of the 160 put. So I'm clicking right now buy at the ask, and I'm going on a bid, and I'm clicking sell at the bid. So when I click over here and I go into the edit spread, you will notice that what I have here in a let me just add one more option leg is a synthetic. And one more time, so let me now repeat one more time the steps that we are doing here. So we have a short put, I'm adding the leg, and in this case we're going to be buying also 160, but it's going to be a call. So when I have this thing, notice what is really taking place. I'm paying for it $22. I'm paying $22 to purchase the long call, but selling of the put, it's only giving me a $12 of the premium. So when I add this up and I go over here and I take a snapshot of it, This is called long synthetic. And in this long synthetic, I'm actually $10 in a hole. So what I'm going to do here to make this thing a little bit more obvious, I'm going to actually add what we have here. We have a long synthetic that involves a buying of the call and also selling of the put. So we have a here buying to open 1 January, and I'm going to put this in parentheses, 2025, 160 call. And the price for that is a debit of the $22. So if this is a debit of the $22, then I also need to do something on this side, and this is the selling of the same thing, January of the 25, same strike price, which is a 160 put. And I'm getting here actually the credit of the $12. And this difference actually makes me being in a hole of $10. So this trade, the way how it's structured, it would actually cost me $10. But wait, there's something more important than just this difference, that this would be costing me a debit of $10, which is basically $1,000. What do we have on each of this? So over here, I have a choice, but not obligation, to buy at 160 the CBOE at any time between now and the expiry, which is the third Friday of the January 2025. But over here, I don't have a choice. I actually have an obligation to buy that. And I need to buy it at the strike price of the 160, which means that needs to get multiplied by another 100. That means I would need to have a 16K in order to trade this. So if I need to have a $16,000 in order to trade this, that's the big outlay of the capital to do something like this, right? So as you can see over here, I have sold that physical underlining way back last month. And what that has done, it has tied up that much of the capital, which is $15,000 for me to do this trade. So be aware of it. For me, in order to place this trade, yeah, it's true. Over here, I would have to pony up $2,200. But over here, I would have a margin of the $16,000. So for me to place this trade altogether, how much would this thing cost? And I'm just talking about the cost of the long synthetic. The cost of this long synthetic, if I were just about to do it the way it is, it would be $18,200. Where did I got this? $16,000 in the margin and what I'm paying over here. And then, of course, I will have to be able to subtract this by the $1,200, and that would give me the net of still big chunk of money, which is basically $17,000. Now, is there a better way? So is there a better way to place this trade? Yes. Answer is yes. And the way how we can do this, we can simply add a long put. So when we are considering adding the long put, what is the one thing that we can do? Well, one thing that we can do, we can actually look at here on a volume and open interest and see, has anybody done anything else in the terms of the selling? So somebody has traded this 150 on the put side 29 times of the open interest. But if I would add more strike prices, maybe I can see something even better. So what I'm looking right now is that it has been also traded at the 150, and it has also been trading at the 155. If I ask for more strike prices, let's ask for 10 strike prices. Do I see that something has been traded right at this level? Let's pick the red here, just to kind of make a distinction. At the 145 on the put side, there has been 113 contracts traded. Okay, so let's now revisit the chart and see where that level is on a chart. 145, we have this green set of unfilled orders, and a 145 would be right above it. So I kind of don't like that, because I would prefer to have something down here, maybe at the 135, as a protection in case this nice uptrend that CBI has gets broken to the downside. Which means in this case I would need to go to my option chain and ask for more strike prices than just 10, which means I'm going to ask for 20 in order to be able to see the 135. Now again, the 135 has not traded that much in terms of the open interest contracts, right? So 135 on a put side has traded only about the 7 contracts. But what about the 140? Did the 140 trade more of the contracts? 140 has an open interest of the 63 contracts on the put side, which means that I could, in this particular case, consider actually adding the long put simply by purchasing the 140 put, which is below the green unfilled orders that we have noticed on the chart when we were looking here earlier. So this is a 140. This is actually it's not below, it's within that area. But what would that do to our spread? Would that do to our long synthetic, our long synthetic that has a short 160 put would now be protected with this 140 put, which means it will not tie up $16,000, but it will tie up the difference of what? 160 minus 140 is what? 20. So that's mean 20 points equals only $2,000. So it will tie up the $2,000. So in that case, let me now take the whole thing over here and build it up as a combination. So as a combination, we still have here the long call that is going to cause us a $22 in a debit. But over here, we're going to be buying to open. Same thing over here. I'm going to just copy this whole thing one more time with the exception of the word call, because we don't have a call. We actually have a put. So I'm going to change this into 140 put. So when I have this 140 put, I'm going to be getting some credit here. And of course, that's going to be altering this whole thing here. So why don't we just go ahead and build this one more time. So I'm going to go over here when I have my option chain. And I'm going to build this from a ground up, right? So if you are here, and let's pick the different account here. This is where I have a position. And I'm looking at doing the 160, okay, and 145. No, not 140, 140 even. That would then be about the $5.45 of the credit. Let's see if I'm going to get filled on that. I'm going to have that sticking here, and I got filled. Now that I got filled for a 610, which is a price improvement, I know that I got paid on this one $6.60. So $6.60. So let me just make sure that I have this correctly done. So I'm just taking a snapshot of this so we can have that in our information that we need. So I'm clicking here and I'm obtaining this information. 660 and 170. So I got that 660 and a 1270. Okay. So now that I have this 1270, and over here is what $6 and 60 cents. $6.60. So knowing this, let's go over here one more time to the option chain and add one more leg to it. So I'm going to edit the spread. I'm going to alter this $12 into $12.70 because that's what the real fill was. And I'm going to add one more option leg. And this option leg is also buy. It's the same cycle and it's a put, but this put is actually at the 140. And this put that is at the 140 has brought the credit to me of the $6.60. So now when I click this OK, I can take a snapshot of this whole thing, and I'm going to make sure that this is also being shown here in a risk graph. So in the risk graph, as you can see over here in this area, I have the layout of the capital that's been reduced. And my layout of the capital is actually only amount of $15.90. $15.90. So knowing this, I can actually now move ahead and sell something against the front call. So we know that we have this long call that is really long in terms of the also duration. So not just of the time, but also of the duration. So then a step 3 could be, so the step 1 is a place long synthetic. Step 2 is buy the long put. And step 3 is add the selling of the call for the front cycle. So if you have any questions, feel free to type it in, but what I'm going to do right now, I'm going to proceed to actually add one more leg to this option chain, and this is going to be the shortest possible cycle. It's going to be October. It's going to be a call. And remember how we looked at the chart and we noticed at the 165 that is the right choice. And in fact, I don't need to execute anything because I have already executed that 165, and I will just pick up from Thinkorswim from that account. What is it that I got filled on the placing that sale? I only got the lousy 45 cents. So when I know that over here I have gotten the 45 cents, now I can update my whole situation. So now my total cost is $16.35. So my entire trade here, this whole trade that I'm looking up here, I'm gonna one more time keep everything here and just add that we sold to open front October 27th, obviously, of this year. So if it's of this year, then I don't need to type in the year. And that was 165. I can add this word just to kind of help people out, which is out of the money call for 45 cents. And the entire outlay of the capital is over here. Margin of the 2K. There's no way around it that's the margin. But the whole debit, as you can see over here, of this is $16.35. $16.35. So the total debit for that, $16.35. So having done this once, I want to actually found a candidate that I can do this multiple times. And in order for me to do that, I want to just quickly revisit the FinViz and see what the market is doing, and then ask myself, do I actually want to do this in this particular environment? So, what is the current environment that we have here? Well, current environment is that we gapped up, as you can see here. Let me just make sure that those lines are a little bit more appropriate. So, we have gapped up, and we actually have the gap below us, and as of now we are holding up strong like a champs, but we might come down and fill the gap. So then should we really place this strategy, or should we maybe trade something else? Well, this strategy, as I have pointed out to you at the beginning, is a bullish strategy. And if we actually want to trade, we need to pick the right candidate. So we have gone over the different scenarios, and we concluded that CBO is bullish, SPY, diamonds, and QQQ are neutral, but the Russell is what? Bearish. So why don't we consider doing something like this on a Russell 2000 and see how this whole thing is going to work out? So let's bring the Russell 2000 over here. I'm going to float this out of the way, and I'm going to type in the IBM here. And as you can see over here on a daily, we have gapped up also on a daily, but we are not lifting much higher. The only problem that we have over here with the daily, that according to the auto climate, usually we're in a downtrend for about a 6 session, and now we're 4 out of these 6 sessions down. So this strategy is not necessarily the best possible strategy to be done, due to the fact that we've been in a downtrend for so many days. So could we then pick another strategy that might be good for us? So let's pull up the option chain for IWM, and consider maybe trading the short-term option, something that is expiring on Wednesday. So I'm pulling up Wednesday expiry, and I want to look over here on a put side and consider a flip side of the bull put, which would be the bear put spread. So in the terms of the bear put spread, we are currently at the 166. We're currently at the 166, and when I'm looking here at the intrinsic value of it, that 167 already has a value of the 26 cents. For the 26 cents, what do they want? They want $1.18. Well, I'm going to do something revolutionary. And what is that? I'm going to actually go ahead and I'm going to be doing buying to open. Let me just spell this out. I'm going to be buying to open 170 put. And I'm going to instantly sell to open something that doesn't need to move at all, which is a 167 put. Now be aware of it. The name for this strategy is a bear put spread, because IWM is sitting right here at the 166.74, right? So be aware of it. What is of the buying of the put? Buying of the put is a locking the selling price. So I'm willing to sell at 170, something that currently is already trading at 166.74. That already has an intrinsic value. So in order to make this a little bit more visual, what I'm going to do here on a platform, I'm going to just quickly go. And okay, it has moved a few cents, right? I'm going to point out to you that 170 is the $3.21 in the money, and all that they want for that it's a 338. So the real difference between the two, rather than me doing the math, is right here, extrinsic value of the what? 8 pennies. 8 pennies. So keep in mind that when I'm buying this unit, and if I'm buying, maybe I should put this in a green and just make it obvious. All that I need to overcome on this trade, all that I need to overcome on this trade is the 7 cents. So if I go ahead and against that sell this particular put, which is 167, how much of the intrinsic value am I getting of the 91 cents? And what needs to happen? In simple words, nothing needs to happen. Absolutely nothing needs to happen. The IWM can stay flat or go down. I will be actually able to profit within this $3 at least 91 cents, because there's one thing that is missing here, and maybe I should just take a snapshot of that too, so you're aware of it, that this is the intrinsic value and this is the extrinsic value. So what we have here is obviously these are the strike prices here. Over here we have a bid, here we have a ask, here we have a what I like to call in the moneyness, and here's a time value, and that time value on this 167 is 91 cents. And when you take that 91 cents, whoever has bought this put, it's really getting screwed, because it has only 27 cents of the true intrinsic value. So if the bell rings, out of that $119 that they paid, they're going to have a $27. And the question becomes, where did the $91 go? $91 went to somebody who sold it. But we can't sell the put unless we what? First buy the put. So what I'm going to do here, and I'm going to do this time with the one contract, I'm going to be buying this vertical that involves 170 as a long and 167 as a short. It's going to cost me $229, which means I'm going to get the $72. So I'm going to fire it in, and I'm going to wait. This thing is going to get filled. What I usually do when I'm trading live and I don't get filled right away, I go over here and I tweak this down. Because in this case, because it's a debit, I would need to tweak it up. So I'm going to be canceling and replacing this and giving them additional penny till I get filled. So I canceled the 28 and I made it in the 29. They're not giving it to me because they're very greedy. They want now more, right? So I'm going to walk through this and I'm going to be now giving them 30. Now look, now they want a 33. I'm going to get this before 33 at some point. So I've canceled the 229 and now I'm placing the 230. So I'm moving on to the next one. And now as soon as I move to the next one, most likely you're going to hear the ding. Actually, this thing is lifting, so if this thing is lifting, and I'm looking here now at the extrinsic value. Now watch, I might actually change my mind right now. I might change. This is only about the 2 cents difference. Do you see that? This is only about the 2 cents difference. I have changed my mind. I no longer want this. I'm canceling this. I'm taking it out of the cancel order. And what I'm going to do right now, instead of having the 167, I'm going to drop it down to 166. And of course, I need to unlock this to ask for 278. And now I'm actually buying the 170, which is what? Intrinsically at the money, $3.54. And I just need to overcome the 74 cents. And look, this stays now at 85. It's even better. A better choice for me. Now I just need to walk this up and give them what they want. So I'm going to give them this at the 180 so I can get filled. 1 Mississippi, 2 Mississippi, 3 Mississippi. You're not interacting with me, so that means you're understanding what I'm actually laying down here. for you. So I'm gonna go one more time. I'm not getting filled. Okay, do not do this in a real life. Changes into the market. Do not do that. I'm doing this because this is a paper trading account. I just want to make sure that I get filled so I can fill this information out. So now I'm at okay, I got filled for 289. 289. But I'm still better off than selling the 167 because notice what is the difference over here? The difference over here is 85 cents versus 75 cents. So really, I mean, just be aware of the fact that now I am actually better off at trading this the way it is with selling the 166, gaining more of this extrinsic value or the fluff than doing the 167. So I just need to alter a little bit what did I do here so it will kind of become more clear. So I have gotten filled here for a 289. This is a 386 and this is a 97. 386 and this is at 97. And only difference is that we have this here. So let me just make this now a little bit more understandable by bringing up the option chain and building this strategy. It's called bear put spread. So we have a bear put spread and then we have a diagonal bear put spread, which is another story because then we actually go further out in time. But in this case, I want a same cycle. So now that I'm in a same cycle, I just need to alter a few of these things. I need to alter this that I'm doing this for tomorrow, which is October 25th, right? So we went ahead, we sold the 166, and we actually purchased the 170. Now that we know where the prices fill, I can type in for the lower one that we are selling, we only got the 97 cents. For the higher one that we are buying, we actually paid $3.86. So when I click OK, this actually gets projected over here. Let me take a quick risk and profile over here for you to see it. So I am looking for this particular option to go down. And as it goes down, I'm actually making money. But that's not necessarily what I want. I actually just want this thing either to stay flat or to go just a little bit down as long as it doesn't go where? Higher against me. In perfect scenario, I would love if this trade could fill me for an amount of uh, $2.89. Because if it's a $2.89, I'm then making the difference, but this is no longer a spread of the $3. You see over here the difference between these two. Okay, by the way, this 166, that's where the current physical underlying is, right? So 166.74 is where the current underlying is. We want the price to close below 166. Okay, so we want that put to be out of the money. Ideally, if it closes at the 165.99, then this at the expiry would be out of the money. Let me just create something here so I can have this explained way better. So I'm going to have here word entry and over here expiry. So I'm dumping these two things in at the same time simultaneously because I want to discuss them one by one. Okay? So if we are just looking at this lower one, which is a 166, and we are at the 165.99, then that would be really completely in my favor. So would this one be. 170 would be also what? In the money. So if both of them are in the money, then what we are looking at here? We're looking at the what? $4. And how much did we ended up paying for this? Remember the fill that I had over here? It was a $2 and what? 89 cents. Now, of course, there's an easier way to find out what is my maximum profit. My maximum profit right here, it's a 111. So it's a 111. So if you want to just get this, like you can take a snapshot over here, and then you have all the information that is visible to you at any given time when you're trading the options, right? So we have ponied up over here $2.89. This is now at the expiry worth $4. So that's mean we ended up gaining. This is our gain. Now, disclaimer. I don't know who your broker is, but both of these legs are going to get the sign and exercise. So if these legs get the sign and exercise, Tastywork charges $5 per leg for assignment or for exercise. So you're looking here like, oh, I have gained the $110. And then the next thing you notice in your account is only the profit of the what? $100. And you're scratching your head. It's like, that doesn't make sense. Why doesn't it make sense? Because it's $5 for the one leg that is at 170. It's $166 for another dollar that is a gain from. So then, is there a better way to exit that? Yes. And what would be the better way to exit that? That would be simply, now do the same thing here. You go over here and you click the opposite side. You bring this up to $4, and most likely they're never going to give you $4.99. They're going to give you maybe $4.97 or something like that. And make sure that you have this time in fourth place. So is there any questions so far? Nobody's asking any questions. So that means that most likely everything is going to be fine. Let's see why this thing got rejected here. Oh, it's a delayed data. That's why it got rejected. Okay, so let me just do this one more time. So create opposite order, right? So we're making this at $3. Sorry, fat fingers. That's what it is. Fat fingers. $3, and now we're gonna type in $3.97. Time in force GTC cent. Okay, $3.97. So the most we can make on it, it's basically $4. But in that case, the market maker doesn't make anything, so we're going to put it to $3.97. So now I have a working order to close this at $3.97, while over here this is sitting at $2.82, because how much would that cost to do this? So now this might sound very ambitious. I like to do this one more time on another product, but we again need to visit the FinViz and see on the FinViz, is there anything that it's looking as bearish as that? Well, we have an energy sector. So XOM. Let's see how energy sector is looking here. Okay, XOM is in the downtrend. It's looking good. The only question becomes, do they have options that we can do on an XOM that are also expiring on Wednesday? I doubt they have a Wednesday expiry. Nope. They don't have a Wednesday expiry. Luckily, they have a weekly expiry, and they have something that is expiring in 3 days. So again, the same approach would be that you look at the chart and decide on a chart, where do you want this to be? Do you want this to be higher, or do you want this to be lower? So what I'm doing right now, I'm floating this so I can just get to the chart below here and look at the XOM. And on XOM, we're definitely heading down. We may actually even hit this level of the 102 or 100. That's interesting. Then which one should I pick? I should probably pick maybe like 115. So let's repeat one more time. What am I doing? Just like I have built the steps over here for a bear put, now I'm doing the bear put on the XOM. So on the XOM, I'm going to be buying to open 115, and I'm going to be selling to open 110. And now be aware of it, that spread is $5. This is now 5 points. If this is 5 points, I need to make sure that I don't pay for it $400, that I paid for it less than that. Because we're almost running out of the time. We only have about 11 minutes left. I'm going to do this a little bit faster. So I'm looking here to buy the 115 and to sell the 110. $4.21. I don't like that because all that I'm making is what? Only 80 cents. I really, really, really don't like that. So what I need to do in this case, I really need to change this, and I need to be able to do this fast because we are almost out of time over here, and I want to make sure that you understand that what is guiding me when I'm placing these type of trades is my recognition of the extrinsic value. 117 and 117, you see, 109 should be better choice. 109. So if I just drop this, just that one slight change from 115 and 110 to the 115 and 109, something significantly is going to be different. So let's do this one more time. I'm buying a vertical, but now I'm doing the 109. And one more time, please, 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 please be aware of it, that now I'm risking more. I'm risking $479, but I'm actually making what? 121. Let's see if I'm going to get Phil on that before I go ahead and start explaining it. Why did you pick that one and not the other one? Well, you see, this is where your eyes should really be focused to distinguish this. If you can learn anything in this one lesson that I have with you occasionally, is that this is what should be guiding you when you're making your decision, which one to sell. Okay, so which strike price to sell. Okay, so there's a couple of answers. 108 put is having $1.15 of the fluff. 109 put has 1 point of the 26. And originally that I wanted to do 110 has the least amount of 83 cents. When you look at these things, I mean, this is just screaming at you, pick me, pick me, pick me. Now again, there's another aspect to it, right? Look at the chart. Look at open interest and volume. These are all the components that come in. And just before I wrap the session up, I want to squeeze this in so you kind of grasp this concept. I understand that this is what it is, like that from one angle, 126 extrinsic value is the best choice for this particular 109 call. But if I were about to look at this, and I'm going to just change this quickly because we're almost out of time. Volume and open interest. 2,000 contracts traded here, 1,600, 3,000 here. This is old information. And I say old information because of the simple reason, because you don't even know when those open interests have been traded. That information is not as valuable to you as the information of today. Now, when you get to the volume, be aware of it, that volume is not just for the selling, it's also for what? For buying. So this is also for buying and selling. Don't talk yourself out of this trade saying like, well, I really should do this one because this is the biggest volume. No, you could have used that logic and talk yourself out of this trade, because look at it. How many contracts have been traded on the one that you actually traded? You traded the 115 long. And don't tell me 389 because that is open interest. That's past tense. Today, only two of them are traded. And if this was a real account, guess what? You're one of those two. You're one of those two. So please, 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 just before I wrap the session up, be aware of it that you got to look at the what? Chart. You got to look at the chart and say on a chart, does the chart support your logic that most likely this could go down below the 109? Yes, that's all that you need. So one more time, a recap of everything that we have done in this 1 hour, okay? We started by simply discussing a big picture and which way to go. We looked at the Dow Jones, we looked at the SPY, and we looked at the QQQ on the monthly time frame. And on a monthly time frame, we have concluded that out of all of these, the Russell 2000 was the most bearish. And we have moved on the Russell, and we have placed a bear put spread on the Russell that gives us a possible gain of the $1.11. Once when I have gone through all the steps, I have jumped also on simplifying these steps and looking at the XOM. And XOM was same kind of strategy, but it involved the different strike prices and risking a little bit more money. Eyeballing it, I thought I'm going to do the 110 as a sell instead of the 109. Once when I have redone this, I actually realized that 109, 115 it was a better choice. And when I have placed it, everything in, I realized that I can make more money on that trade than on something else. Then I have taught you, don't only look at the option chain, you got to look at the chart, and that goes without saying. You've been around long enough to know, and you also need to look at the open interest. So once when you look at all these things, be aware of it on a big picture. Dow Jones is having a very interesting juncture on its road, whether it's going to join the Russell and move down or it's going to bounce and go up. The QQQ is, as of now, although the whole month has passed, it doesn't even have a body in terms of the red or green. It just has a indecision doji or a sideway. And we're at a really interesting point to figure out, are the earnings today of the Microsoft and Google going to push us up or are going to push us down? If they're going to push us down, as the QQQ goes, most likely the rest of the market is going to go, because the technology is at 27% of the S&P and the Dow. And one more time, I just want to wish you a good trading and make sure that you have always hedged position and stay hedged and have a good day. Bye now.